Hey there, everyone. Welcome to the Final Bar. It's Wednesday, July 3rd here on this shortened trading session before the 4th of July holiday. I'm Dave Keller, the Chief Market Strategist here at Stockcharts.com in a sunny and beautiful Redmond, Washington. Thanks for joining me today and every weekday after the close as we break down the market action. As a reminder, no trading tomorrow for the 4th of July holiday, so happy 4th to all of you. And we will not have a show on Friday because we will be on vacation. We're actually working up some special episodes to share with you next week, digging a little deeper into some of the top charts we've been selecting every month. Grayson Rose and I have done a monthly exercise sharing with you top charts to watch for every month. I'll give you a little bit of a behind-the-scenes look of how we're selecting those names, an update on what those names have done since we picked them in the different videos, and how you could manage risk effectively using stock charts and the best practices of technical analysis. But let's get to today's shortened holiday session, see what happened as we get into our market recap. Looking at the major averages, you can see, honestly, following the normal playbook for a shortened holiday, shortened day before a holiday, basic playbook would be lighter volume and gently higher prices would be the way that I would describe it, and that's pretty much what we saw today. S&P 500 closed above 55.36, and that's up about 0.5% from Tuesday's close. And Nasdaq Composite up 0.9%. And the Dow, almost actually finished in the green, but just did finish slightly below that zero level to just above 39,300. Mid caps and small caps all positive as well, but we continue to be dominated by mega cap growth, and that's what it looks like when the Nasdaq is up, the Dow is down, and the S&P in the middle. That is a growth-led bull market. That is where we're at. No real significant change in the volatility picture. The VIX remains sort of in the low 12s, and VIX in the low teens is a low volatility, low uncertainty, low fear, basically high confidence bull market phase is how I would summarize that reading. Looking at interest rates, you can see the 10-year yield and long bond yield both came down today. The 10-year yield finished the day around 4.35. You can see that the long bond yield around 4.52, we'll call it, and the 5-year point around 4.31. So, rates overall coming down here. That's certainly helping. You have weaker dollar, stronger bonds, stronger equities. That's kind of the, and low volatility. That's sort of the bull market playbook, which what's helpful about that is just look for the opposite. So on this page in particular, on the market overview on your dashboard, if you click on bonds, I would think the risk for the markets here, as you've seen stocks rally driven by growth stocks, would be a spike in the dollar and a spike in interest rates, because those two things would most likely be aligned with weaker equity prices, because we've had stocks rallying on lower rates or rates remaining, not really rising too much, and the dollar not really breaking out yet. Looking at commodities, a bit of a mixed result here, but overall I wanted to focus on precious metals, which did quite well today. Gold price is up another 1%, silver price is up over 3%. When I do my weekly scan for stocks making new swing highs and lows for my Market Misbehavior Premium members, noted some gold stocks on the list today. Newmont Mining popping up there, which is sort of an interesting new appearance. I'll get to that chart a little later in the market recap, time permitting. All red here, looking at the cryptocurrencies. You can see Bitcoin currently just below 60,300. That's down about 3% from yesterday. Ether price is slightly below 3,300. That's down about 3.5%. You can see the rest of the top 10 coins down today. Interesting, Bitcoin once again hitting 60,000. So often we've talked about big round numbers that tend to have meaning, and particularly in crypto land, particularly in Bitcoin, just draw horizontal lines at all the 10,000 increments, and you will find they tend to be very powerful pivot points, meaning a level that has meaning for that particular chart. It happens so much, it can't be an accident, would be the way I would describe it. Let's look at the 11 S&P sectors. You will see that most of them, at least over half of them, finished in the green today. Technology continuing to dominate on an absolute basis, on a relative basis. It continues to be technology and then everything else in my evaluation of the evidence. Tech was up 1.4%. Materials and consumer discretionary both up about 0.7 to 0.8% today. Four of the S&P sectors finished weaker. Healthcare, the worst performer, down 0.8%. And boy, if you're looking for a sector that's not doing particularly well, Healthcare is probably my favorite example at the moment. The relative strength continues to deteriorate. Really, relative strength from the end of 2022 through today has been relatively weak. So no real change to that long run of underperformance for the healthcare sector. Financials, number 2, down about 0.25%, followed by consumer staples and real estate, both slightly lower. You know, we're still in the middle of the week here, but my market trend model remains bullish on the S&P 500 on all time frames. And I'm asked a lot in this sort of environment, like what would it take for you to turn less bullish in terms of positioning? Because I talk a lot about potential warning signs, but in terms of my positioning, I'm very much geared towards large cap growth on my own accounts, because those charts are working. And if you want to know what kind of things Dave owns, look at the charts that are going up and the charts that are outperforming. Those are probably the things that I own, because as a trend follower, it is a momentum-based system, which is what I use. I follow momentum. So if momentum's in Meta and Alphabet, those are the types of things that I'm going to want to own in my own portfolio. That's probably where I'm going to be. And my market trend model really kind of loosely defines how I'm positioned. So when we have all 3 of these bullish, that means I'm probably fully invested and as much as I'm happy with and looking for opportunities. When the short-term model turns negative, that tells me to maybe be a little bit more cautious and be a little more tactical. When the medium-term model turns negative for me, that's when I'm probably stepping on the gas. So short-term model turns negative, I'm taking my foot off the accelerator, I guess is a good metaphor. And then when the medium-term model turns negative, I'm stepping on the brakes and unwinding positions, probably raising cash and protecting from further downside potential. Looking here at the mega cap leadership names, boy, Tesla continuing to have just an absolute banger of a week. Tesla's up 6.5% today, Nvidia up almost 5%. So if you're wondering why consumer discretionary and technology are looking pretty decent today, there's your answer. Apple also up about 0.6%. On the downside, I mean, Meta, the worst performer of this group of names, and it was still slightly higher. So, generally speaking, the biggest names, the growthy names, the names driving the conditions higher continue to do quite well. By the way, before we get any further, I do want to let you know we have a 4th of July sale, kind of a flash sale, just came out, was just announced, and it's happening right now through the holiday week. We often save our special deals for Cyber Monday for the holiday season. We actually have a really cool 4th of July sale happening right now. If you've never been a Stockcharts paid member, now is the time to do it when you can get the best deal ever. Sign up now. We have a series of different levels and a number of different time frames you can sign up for. The longer that you sign up for, the better the deal that you're going to get. Up to 2 months free on your account. By the way, if you're a current member, renew your subscription today. You get the special deal. They'll just add the time on to the end of your current deal. So check it out. Go to stockcharts.com/special to look more information and to sign that up. Do it today, won't you? All right, continuing on here with our market recap. Let's look at the S&P 500, the daily chart. And as we're looking at the daily S&P 500 chart, you can see a new all-time closing high. We closed above 5,500 for the second time in history. Yesterday was the first time, by the way. So today, yesterday's significant break above that level followed through with another update today. And again, I've learned not to draw too many deep conclusions based on one trading day on a shortened session and or a holiday weekend. So I would say Wednesday and Friday of this week, I wouldn't draw too many conclusions from the day's trading, but I would think about the bigger picture and what today's move means within the context of the larger term trend. And I would say what's happening the end of this week is we're finally breaking out of this short-term consolidation. Right on the tactical time frame, we've been kind of between 5,450 and 5,500. Jump into a little shorter time frame so you can see that little congestion area I'm talking about. Certainly seems like we're resolving that to the upside. But I don't think anything changes for me, right? For me, this pink shaded area around 5,400, that's also a trend line using the major lows over the last 8 months. As long as that holds on any sort of pullback, this is still a great market showing a lot of strength. The 50-day moving average is currently around 5,300, same thing. I think holding that is pretty good. For me, I mean, what would really cause me to be negative? What would cause me to be a little less bullish optimistic would we break below 5,400. What would cause me to be downright bearish would be a break below 5,000. But that's a long way away, right? That's a 10% drop below current level. So I think the reality is this market has a lot of room to go on the downside and still be within the context of a primary uptrend. That is the reality of this market. That's the seasonal story that we would expect in July, which has been one of the strongest months going back to the 2009 low. I would say long and strong in July, but looking for signs of a top. And I think the weaker breadth conditions, as we've observed, probably the most obvious signs of topping conditions more than anything. In my breadth chart list, by the way, I have a series of charts digging a little bit more into breadth conditions. We don't bring some of these up as often as probably we could, but I was looking at this one earlier just to get a sense of, with today and yesterday, Tuesday and Wednesday, how many stocks were up or down. We have a series of indexes which track advancers, decliners in the New York Stock Exchange. This is a chart that I have on my breadth chart list. Just shows you the percentage. So this is 67% today on Wednesday's session closed up. 31% closed down, and the rest of those basically were unchanged or flat for the day. And so basically 2/3 of the New York Stock Exchange listings were up today. It's about the same yesterday. So, nice sort of participation over yesterday and today, with most stocks closing up and with the benchmarks going higher. And that sort of refutes the discussion that we've been talking about a little more often, which is the fact that many stocks are not participating. And, while you have a couple days here where there's been decent breadth participation, the longer term breadth story is less encouraging, right? There's still 67% of stocks above their 200-day moving average. That's down from around 85% a couple months ago. End of March, you had about 85% of stocks above their 50-day. Now it's down to less than 50%. So while these are not necessarily concerning levels just yet, it certainly speaks to the fact that while the S&P is clearly above two upward sloping moving averages, there are a lot of individual stocks that look nothing like that. And so to me, it reminds me of two things. Number one, be wary of the fact that at some point these leadership names could take a breather, and then the question is going to be, are people rotating to all the junky stuff that has not done particularly well? And I'm not sure that's going to be the case, because if not, that could be a cause for real deterioration. Or number two, right, looking for improvements in breadth, and that would tell you more of a broad advance. And I think the bull case from here, strength in July and into August and beyond, would have to be breadth conditions improving from here. This narrow-led market, to me, just feels unsustainable. And I feel like if you don't own those mega cap growth names, you're probably underperforming, which is not a comfortable place to be for active investors looking at the equity space. So as always, be vigilant, I guess is the word I was looking. Diligent and vigilant. I try to say both of those at the same time, but be aware, I guess, is the easy way that I would say that, and focus on the right market conditions. All right, let's go back to, I want to talk about gold, because gold stocks have actually come up on the swing highs list. I run a scan every week for my Market Misbehavior Premium members where we look for stocks making new 3-month highs and new 3-month lows. And I started doing that years ago because I found that was a really good actionable set of names, right? I found that when I wasn't scanning for those moves, I would miss things, right? And something would have done very well, and I wouldn't know about it until it had already performed quite a bit. By scanning for stocks making new 3-month highs, you can often catch things a little early on. And gold stocks like Newmont Mining came up on the scan today. So I took a little, just another look at gold. Now, spot gold, which on our platform using the gold futures market is $gold, GOLD. But the GLD is an ETF that tracks physical gold, and it maps pretty well to it. So we're going to use it today. I mean, I think the chart of gold, has not been bad in quite some time. It's actually been pretty constructive, and I would say been most constructive since the breakout that we saw in March, right? End of February was sort of stalling up to resistance around 190, 192 for the GLD. We broke out there at the beginning of March, and from there had just this incredible move higher and higher. This is spot gold is going well above $2,000 an ounce and continuing upwards. From there, we stalled out around 225 for GLD and then pulled back to around 210 to 212. That is sitting right above the 38.2% Fibonacci level, which for me is sort of that, a warning sign, right? As long as we hold above the 38.2% level, conditions are not that bad. You start to break that, and I think you have to question whether we're still in an uptrend. And as long as this remains holding where it is, at the very worst, it's an okay chart and potentially is setting up for something greater. Today's gap higher on the GLD puts us back above the 50-day moving average. Just to zoom in a little bit here, you'll see that the last time we gapped above the 50-day moving average, we immediately came back down the next day. So keep an eye for that. But, assuming we can, maintain some upward trajectory above the 50-day, that means most likely a return back to 225 to retest the previous highs. A lot of upside, a lot of daylight above that level if we can get above 225. But for now, I like the setup in gold. And transitioning to some of the individual names, Newmont Mining coming up on the list today here. It's not quite getting above that May peak yet, and I think that's why I'm watching that $44 level. I set an alert on Stockcharts for Newmont over 44. I would encourage you to do the same. And again, that breakout would just confirm, I think, what the trend has been suggesting, which is that we're in a bullish phase of higher highs and higher lows. We just need to keep making that higher high. We're finding support in a descending 50-day moving average, which is pretty good. The RSI is holding above 40 on pullbacks, which is pretty constructive. We just need that breakout to kind of complete that rotation. But Newmont Mining might be an interesting place to be. Other, gold sort of things to look at would be like the GDX. Another, gold stock holding ETFs. Another one, this has a higher low around $33. I would see if it can hold that if we do get any pullback. But overall, the setup could be pretty constructive here. We're obviously seeing plenty of strength in the semiconductor space. And again, anytime I'm scanning for stocks in positive positions, semiconductors usually come up because they've overall been quite strong. We could talk about a number of individual names, like Applied Materials comes to mind as a really good chart to think about. NVIDIA, of course, we've talked about very often. I'm going to zoom in a little bit to the candle chart to just show you what's happened in the short term with semiconductors. If you're more of a swing trader, this is the type of time frame I'd be looking at the last 20, 30 sessions. And just look at the candle patterns, right? Here at the peak in mid-June, we had a bearish engulfing pattern. That's an up day and a down day. The range of the down day, open to close, what's called the real body, engulfs the real body of day one. That is a bearish engulfing pattern, which usually says the next 1 to 3 bars are going to be lower, and that's basically exactly what we saw here with semiconductors. But after a couple days down, look at what happened. Literally, you can see that we were range bound here. We have a bunch of different candle patterns like a dragonfly, doji, and others, but look how we're in a very stable sort of sideways period. And what John Bollinger, I remember hearing a presentation earlier on in my career that John gave, and he talked about volatility contraction, meaning the volatility is coming in, and when that happens, you're just looking for the break. And that's when prices usually break out of the Bollinger Bands. That's when things sort of have consolidated, and then there's a new catalyst for change. And here it certainly appears like semiconductors are changing to the upside, getting out of this range we've been in for the last couple weeks. Immediately thinks on the tactical time frame, look for potential resistance around 278 to 280. That would be the resistance from mid-June. And if we could eclipse that, that suggests further upside to be had. But the setup in semiconductors, again, continues to show strength. Speaking of strength, Tesla has gone from, I think, a joke of a stock where you're debating whether or not it deserves even to be mentioned in the realm of other mega cap growth stocks. I was back here in April when it's down around 140. Now, of course, we're back to 245, having gained almost doubling the value that we saw at the low there. I mean, what an impressive gain. Again, the inspect tool can give you a quick way of showing from that low, left click and drag to where we're at today. Yep, that's about an 80% gain in about 6 weeks. Not too bad. A little more, like 8 weeks or so. But again, nice rally off of the low in April. So what now? I mean, the conditions are, we're extremely overbought, which means two things. You probably have a pullback coming soon, and when you do, you probably have at least one leg higher. A good analog to pay attention to, classic move around this sort of signal would be June and July of last year. You can see in June, we're making a new swing high, breaking above the 200-day moving average. The RSI gets above 80. That's exactly what we're seeing here. You had a brief pullback soon after, and then one more leg higher before the topping pattern commenced. And so that's kind of the base case you can expect when the RSI is above 80. Extremely overbought, we would always call the good overbought. It means it's gone up so much, you have a lot more upside momentum probably to be had, but be ready for a pullback. And often that can be a nice swing trade opportunity to ride that next leg higher into what could be the eventual peak. I want to talk about Humana. Healthcare, again, has been a really rough place to be. And I think what you have to remember about charts like HUM is that we've had a nice rally off of the lows, but now we're starting to stall off a little bit. I wanted to show just the candle chart of this because, and again, I don't use a lot of candle charts on the show only because we tend to be thinking a little more medium term, long term, but I often bring them up because for me, the candle chart gives you a good short-term reference point about what's happening, right, on that tactical time frame. So if I was actually pulling the trigger on a stock, I often bring up the candle chart just to think about the short-term dynamics and just make sure I'm understanding about whether we might see some short-term weakness or strength given on that, given the candle patterns that we've seen. I just want to highlight these long upper shadows that we've had over the last couple of days. This is a shooting star candle that we had. This would be on Friday of last week. We had the gap higher, long upper shadow, little lower shadow, and the open and close near the lower end of the day. Again, yesterday or 2 days ago, we had another one with a long upper shadow. So those candles basically tell you there's an absence. There's the buying power evaporates over 375 because we've gone up there a couple times and we kind of come right back down to earth. So today's move lower, while painful, down about 3.25%. I think that comes after some cautionary candle patterns that tell me to just be wary and to hold off. So it certainly looks like a little bit more downside could be had. I'm looking at the 50-day moving average, and the previous swing lows are all around that 345 to 348 range. Maybe that's where we could reassess and see if we hold support there. That's where we've actually had some interesting support levels hold previously. Finally, we'll finish today's show with DoorDash, ticker DASH. It's obviously a food ordering app, I guess is the way I would describe it. And I just want to show just a simple analog. And an analog just means what we're seeing right now looks similar to a previous period. And an analog means here's what happened last time, so let's think about and overlay that experience to what we're seeing now. And I would hesitate to say this happened last time, so the exact same thing is going to happen. A lot of people try to do that. I think you're getting into some questionable statistical analysis if you're taking one observation and saying this new one should be exactly the same. But thinking about what the conditions were like, thinking about what signals helped you interpret that period, and then applying a same diligence to what we're seeing today, I don't have a problem with that. So I just want to highlight that DoorDash is doing what it did exactly in the third quarter of last year, from end of July through the really mid-October. We had made a new swing high, and then we started to rotate lower highs, lower lows. We went below the 50-day moving average, which started to slope lower. The RSI went into more of the bearish range, remaining mostly below 60. But then look at how things changed here. After we pulled back to the 200-day moving average, we had the nice gap higher, and then we sort of followed through. The momentum improved, the relative strength improved. All of that improved after a bounce off of the 200-day moving average. The reason I'm highlighting that is because DoorDash is right back at the 200-day moving average again. If you're more aggressive, if you're more of a buy the mean reversion, buy weakness, and bet on a reversion upside, this could be the sort of level you're looking for because it represents a stock that has gone down, but it's hitting a potential support level. I tend to be a little more conservative and wait for a reversion back higher, which is why I use indicators like MACD or PPO to actually trend, show that the trend has reversed. Look for a higher high and higher low, getting back above an upward sloping 50-day moving average, and I'm okay sacrificing the beginning of that move just to confirm that the uptrend afterwards is most likely to persist. So keep an eye on DoorDash. Again, if you're a little more aggressive, maybe this is the time to take a shot. If you're a little more conservative, think about what signals, what patterns you would need to look for to compel you to take action on a chart like this, which has been struggling here for a couple months. Folks, that's it. Thanks so much for joining us every weekday after the close for the final bar. Again, we're off Thursday, Friday this week. We'll have some special programming for you next week, and we'll be back the week after. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.